the event of an emergency, please follow instructions from the staff and exit through the doors clearly marked with the exit sign and blinking right now. Kindly switch off or silence your mobile devices. Please note that this session is streamed and recorded. During the Q&A, simply raise your hand and a microphone will be brought to you. And for those active on social media, the official event hashtag is #EPCA59. We invite you to join the conversation. Finally, we would like to remind everyone of our EPCA do's and don'ts. As you're all aware, we must refrain from discussing any sensitive market information. Compliance with competition law is not just expected, it's one of EPCA's core values. And now, without further ado, let's begin.
So, hello, thank you everybody, welcome. It's a pleasure to be here among so many distinguished guests and so many familiar faces as well. Great to see you all. My name is Adam Bland. I am Executive Director for Specialty Chemicals at S&P Global Commodity Insights. As we navigate a period of profound disruption, our session, Charting Opportunities in Turbulent Waters, sets the stage for how leaders in the chemical industry are facing the challenges today and in the future amid increasing volatility and uncertainty. Obviously, if you don't know already, S&P Global Commodity Insights offers a comprehensive suite of capabilities ranging from pricing benchmarks, market analysis, to consulting, technology, and of course training. Our integrated approach, basically from the wellhead to Walmart, helps clients not only understand market shifts, but also to anticipate and respond to them, ensuring you have the intelligence needed to make strategic decisions in a rapidly evolving landscape. So, over the next 90 minutes, following my opening address, I'll be joined by my esteemed colleagues, Ian Young, Editor-in-Chief, Chemical Week, who will be moderating a session on the impact of tariffs and anti-dumping duties on competitiveness. Following that, we will have presentations from Andy Orzinski, Director of European Ethylene and Derivatives, Katie Elliott, Head of Global Aromatics, and Neetu Singh, Inorganics and Vinyls. So they'll be highlighting scenarios for the European-based chemicals. And after that, finally, we'll have Olivier Marinoid, Head of Methanol and Plastic Circularity, and David dos Santos, Pricing Reporting, will tell us all about Europe's prospects as a sustainability frontrunner. So, very briefly, I'll give a very quick overview. I'm not going to be stealing too much thunder from the rest of my speakers because I'm sure they'll cover these in details later on. So basically, the emerging challenges and the opportunities will shape and advance the chemicals industry in the next decade. The global chemical industry is entering a decade defined by both turbulence and transformation. On one hand, geopolitical upheaval and energy price volatility are creating an uncertain operating landscape with trade tensions, shifting energy markets and challenging supply stability. Global supply chains are also being reshaped for resilience, and companies adapt new trade realities and regional strategies. At the same time, sustainability pressures are mounting. The push for plastic circularity and the rise of carbon markets and aimed at net zero emissions are forcing chemical companies to reinvent processes and products. This sustainability drive goes hand in hand, basically, with a pivot towards renewable feedstocks, reducing some reliance on traditional petrochemicals. Meanwhile, however, technological innovation is accelerating, whether it's from digitalization to advanced materials, offering opportunities to boost efficiency and develop new solutions, whether it's lightweighting, whether it's durability, or even energy saving in its final application. Finally, evolving end-use markets from emerging economies, consumer growth, basically whether it's durables or whether it's new applications like electric vehicles or sustainable products, they are posed to drive demand going forward. So, basically, the economic foundations that we relied on once, such as low inflation, easy money, and the seamless global trade, they've become increasingly unstable. First, the global financial framework is shifting. The dominance of the US dollar is being questioned, with emerging powers like the BRICS nations pushing for new alliances. This is loosening the world's financial anchor, and it's introducing new uncertainties across markets. Second, inflation has returned with force. Supply chain disruptions, trade tariffs, and post-pandemic demand. Basically, it's driven prices up, especially in services where costs remain stubbornly high. In response, central banks have raised interest rates to levels not seen in generations, but this tightening is slowing growth and exposing vulnerabilities. Governments, of course, now facing high deficits. Geopolitical tensions and rising tariffs are reshaping commerce. Supply chains are regionalizing, and countries are prioritizing domestic or friendly sourcing over globalization. The era of frictionless trade is fading, and businesses must now navigate a more fragmented, costly, and complex global landscape. In this chart here, you can see obviously the oil price. I mean, there were, you can see production cuts in 2022 and 2023 to shore up the prices. Plans basically to try and increase output in 2024, but they did see delays in the second half of 2024. Obviously, of course, with the weakening economy. But basically now in this year, we've seen unwinding of voluntary cuts in 2025 this year. Well, basically, the oil prices are currently supported by strong seasonal demand and elevated geopolitical risks. Summer fuel needs and tensions, like the EU sanctions against Russian exports. And, of course, we've seen recently the strained US-Russia relationships. These are basically keeping crude prices buoyant. But beneath that, the fundamentals are softening. Basically, as seasonal demand fades, this excess supply will put pressure on prices going forward. Our outlook sees dated Brent falling from about $71 in July to $58 in December this year, which is going to be a drop of over $10. For the full year, Brent is projected to average about $68, which will decline further to $56 in 2026 as the average as this surplus persists. So unless basically we see OPEC production cuts or surprise demand, prices are likely to remain capped going forward in the near future. So near-term forecasts for crude oil and natural gas are widening the cost gap between ethane and naphtha cracking regions. In North America and the Middle East, ethane feedstocks are basically linked to natural gas prices. It remains significantly cheaper than naphtha, which tracks, of course, higher oil prices. And this gives ethane-based crackers a clear competitive advantage, especially in the US, where ethylene production costs are far lower than that in Europe or in Asia. Meanwhile, naphtha-based regions are facing margin pressure. Elevated oil prices and weaker demand recovery are continuing to squeeze profitability and prompting some operators to try and look at these reduced operates or even consider rationalization. So in this slide, the global refined product demand is entering a turning point. While long-term trends basically point to structural decline, 2025 actually is shaping up a little bit stronger than we expected. We've revised this year's outlook upward, now forecasting global demand to average around 90.9 million barrels per day, which is roughly about 220,000 barrels per day higher than in 2024. This modest kind of bump basically reflects the resilient gasoline use, particularly in the US. Also, jet fuel is rebounding with a lot of air travel. Diesel remains obviously essential for freight. And basically, gasoline demand is developing markets, is holding steady. So beyond 2025, the picture shifts. Mature markets like the US and Europe basically begin a steady decline, driven by electrification and efficiency gains. China, of course, once the growth engine, is now projected to contract by 170,000 barrels per day in 2025. By 2050, US demand could basically fall by 6.5 million barrels per day, and Europe by nearly 6 million. Emerging markets, basically they'll offset this a little bit. India and Africa are expected to add over about 2 million barrels per day. Well, obviously that's not going to be enough to reverse this global trend. So finally, throughout 2024, we have seen a bit of a brief respite in new capacity, but that pause is basically short-lived. If you look at 2025, a new wave of petrochemical capacity has basically hit almost every value chain. Basically, effectively prolonging this current down cycle. Global ethylene capacity additions, they jumped roughly 9 million tonnes in 2025 and 11 million in 2026. So basically, after adding only about 2.5 million tonnes in 2024, similarly, paraxylene saw very little volume in 2024-2025, but that will get another surge in 2026-2027. So basically, the story is the same across propylene, methanol, PVC, and new plants continue to come online. So the upshot basically is that the industry's trough and the conditions are going to linger for longer. So with that, I'd be very happy to hand over now to Ian Young. I'd like to welcome Ian to the stage, please, and continue the next session. Thank you very much. Cheers.
Okay, so thank you very much, Adam, for that kind introduction. I'm Ian Young, Editor-in-Chief of Chemical Week, part of S&P Global Commodity Insights, and good afternoon to you all. I'm delighted to be moderating this panel session this afternoon, and I'm thrilled to be joined by three members of the Platts petrochemical pricing team. We're going to talk about tariffs and other trade measures, such as anti-dumping duties, their impact on competitiveness, and also their possible impact on changing chemical trade flows, particularly in Europe. But before we do that, could the panelists please just say a few words about themselves, introduce themselves?
Sure thing. Yeah, thanks for having us today to the EPCA team. My name is Daniel Pelosi. I'm the Senior Price Reporter for benzene and styrene in Europe.
Hi, I'm Marilena Tsimeki, and I'm the Manager of European Intermediates in, nice to see you here all.
Hello, I'm Luke Milner. I'm the Associate Editorial Director for Chemicals Europe.
Okay, thanks all. So tariffs. I mean, really, it's been a central theme, a central topic for the industry this year, with every successive announcement by the US administration, and I'm sure there'll be a few more. Daniel, how have chemical markets been reacting to all this?
Yeah, I think to use the buzzword of the industry for this year, it really has been uncertainty that's been the primary impact of the tariffs across both the European markets but global regions as a whole. The volatile geopolitical approach from the Trump White House, coupled with the variety of responses from key global stakeholders to the news here, has really been the critical driver of which has clouded company operations, limited the degree to which planning can take place to elevate performance across the rest of the year and the second half of the decade as a whole, and also kind of factor into a variety of shifts in both domestic market fundamentals but also global trade flows and regional interaction. So I think one of the key dynamics here is in terms of exporting material to the US. This has been very, very impacted by the tariff and the initiation of such policy by the White House. A particular example here comes from the markets which I cover, which are benzene and styrene. Benzene typically operates as a net exporter of Europe, acts as a net exporter of material to the US, and this serves as a key outlet for supply in the region, allowing for slightly more balanced fundamentals domestically. And as a result of the uncertainties surrounding the movement of material into the US, given the adoption of the tariffs by the US government, we have seen consistently lower levels of exports of benzene across the year, on a spot basis at least. So even in instances, as we can see from the chart on the screen, where Europe has continued to command a strong premium to the US market, and where You know, in principle, arbitrage could be open. We don't see that flow continuing as consistently as it would be in previous years. And across, you know, our coverage of the benzene markets, we hear traders consistently quoting a $5 to $15 loss making in any arbitrage to the US across, say, the last 2 quarters of the year to date. So this is really, you know, kind of exacerbated oversupply in this market, and we see this trend repeated consistently across other areas where product is moved into the US market from Europe. With this in mind, I think what the tariffs really have emphasized is the importance of localized supply chains. We saw a lot of this comment across various company results that were reported earlier this year. If you can rely on localized sourcing of your material, domestic kind of relationships with your consumers or your suppliers, you're at a slightly stronger position in terms of market interaction, you know, across the year. Whereas those that are relying a little bit more on the intercontinental trade flows have found themselves with slightly more challenging operations and a realignment of their strategies towards the market as a whole. And I think this has, you know, really been one of the kind of critical trends in this regard. You really see more of a regionalization, more of a realization from a huge number of European players that you know, the continent is in many ways on its own, that we're living in a more protectionist and regionalized market, global market environment, and that measures have to be taken to mitigate the impacts of that difficult environment for players. Having said which, I think that, you know, the key thing to note with the tariffs, and I think sometimes it goes under the radar in our day-to-day market discussions, is that it served more as an amplifier or an exacerbating factor for the structural difficulties and the you know, the key challenges that the European chemicals environment faces, you know, and has faced across the first half of the decade. So, you know, even though we have this volatile geopolitical picture and this, you know, changeable political reality that is impacting the markets on a day-to-day basis, this is not, you know, pushing the market away from any kind of structural oversupply in the European continent, any lack of competitiveness against players in China or the US, or the ongoing weakness in demand, particularly in key downstream industries like construction and automotive. While the tariffs have maybe, you know, shielded the continent in some ways from some of these pressures and dominated market attention across the year to date, these are the trends that really need to be reckoned with for most players, particularly that lack of competitiveness against other regions that is really impacting you know, the way in which the European market operates and its future for the rest of the decade and beyond.
I think really if I jump in here, competitiveness is the underlying theme of this panel discussion, right? So whether we're talking about anti-dumping duties, whether we're talking about tariffs, it all comes back to competitiveness. And that's something which the industry as a whole has had to really think about over the last 18 months, for last year in particular, looking, you know, whether we're talking at a cracker level or talking right down through the chain and even into the recycled markets. Everybody is having to stop and reevaluate their position and look at their competitiveness. You know, we've seen in the recycle markets some closures, and at a higher level, what we're seeing is that rationalization on, you know, across the various crackers, and not just in Europe either. This is something we're seeing, you know, in other markets. Japan, a perfect example. I think, you know, this is something which we're going to be hearing more about in the coming months as well. It's a very interesting developing situation. I'm not going to go into too much detail, as I'm sure it's going to come up a lot more in the presentations that are about to happen. But certainly that element of competitiveness is something which we really have to bear in mind throughout the whole of this discussion, but also I think going forward in the coming years.
Thanks, Daniel. Well, sticking with competitiveness, Marilena, what measures, what instruments could Europe use, in fact, is it using right now, to ease the pressure that is felt across the industry? And I mean, how successful have they been so far?
So, you know, Ian, that when you were speaking about Europe's competitiveness, I think it's clear that the region has been under a lot of pressure. So basically energy cost remains a major issue and has put producers at a great disadvantage against, let's say, compared to the US and Asia. And on top of that, you also have challenging macroeconomic conditions, lower consumer spending, and global oversupply, which definitely don't help. And we see the consequences of that in the acetone and phenol market, for example, where Ineos Phenol announced the permanent closure of its plant in Gladbeck, and Orlen this year also announced that they're winding down their acetone and phenol plant in Poland by the end of the year. So we talk about real rationalization happening right now in Europe, with main factors being like the very low demand, high energy costs, and growing competition from regions which have cheaper feedstocks and less regulatory burden. And in many cases, producers are simply unable to profitably operate under these conditions, especially when competing with these structurally lower cost producers in these regions like Asia, the US, and Middle East. So yeah, in basically looking at trade defense tools as well, anti-dumping duties are one of the few mechanisms that are available to help shield the European industry. So we're seeing on anti-dumping duties on downstream epoxy resins, aimed at protecting basically the European industry and its workforce against, let's say, unfairly low-priced imports from China, Taiwan, and Thailand. So, but again, Korea was excluded from the final, during the final ruling, and we're also hearing that during the investigation, India and Saudi Arabia, which were not covered by these measures, were offering very competitive priced imports into Europe. So that means that potentially here the dumping duties did not have a strong impact as hoped. And then you also have India, which proposed ADDs against China, Korea, Taiwan, and Thailand. Yeah, that could potentially mean that Korea could be under more pressure to export material into Europe. And then in this, staying in this chain, benzene and phenol chain, adipic acid is also one product that where the market waits for a decision on anti-dumping duties against Chinese imports, and that will come very soon, actually.
Well, I think I'm going to jump in again. On the anti-dumping duty side of things. I think you've raised a number of very interesting points, but it is worth saying with anti-dumping duties, they sometimes come with unintended consequences. So if we think about the provisional anti-dumping duties that have recently been announced for ABS, what we've been hearing from the market is, on the one hand, we have European producers saying these measures aren't going far enough, they're not doing enough, it's not going to have the desired impact. So they feel that the situation in Europe isn't going to change particularly as a result of these. However, on the other hand, what we hear is from some of the Asian suppliers, they're looking to redirect some of the material towards the UK rather than the European Union. What that means for European producers is merely moving the area of competition from one geographical location to another. At the same time, you also have to bear in mind what's happening downstream. And at what point is it simply easier for people to produce the downstream products outside of Europe and import them in? So that's another factor which really has to be taken into consideration, because when we're looking at this, we have to look at it as a whole. We have to consider the downstream markets and the demand, because if that demand isn't there, then it doesn't really matter what measures are put in place. And that really is the most important factor when we're looking at this, I would say.
Actually, tools like ADDs can definitely help, but they're just one piece of the puzzle. So Europe just needs a broader strategy, such as policy support, energy cost relief, and also needs like encouraging innovation in order to be able to compete in this global market that changes so fast. Because there are many products that are highly exposed to international competition, but yeah, they just don't have any kind of trade defense tools in place, and while the pressure is just as intense. Take acetone downstream MMA, for example, methyl methacrylate that I'm covering. So European MMA has been facing a lot of pressure from competitive imports from China, Korea, and Saudi Arabia, but it doesn't have any kind of anti-dumping duties in place. So since Mitsubishi idled its plant in the UK in 2022, I think it was, basically the market has become very heavily reliant on imports. So in this market, the prices are mainly driven by supply-demand dynamics, but you also might see some changes in trade flows as well. So Room's new plant in Texas, the Lima plant, has started ramping up. So that was expected that it could ease like European exports into the US, and at the same time that could potentially reduce Chinese imports into Europe. But yeah, so basically we see that this might not happen, but there are just this kind of expectations. So yeah, the flip side of this, by the way, is that if demand in the US remains sluggish, there might be more US origin material coming into Europe and put even more pressure in an already oversupplied underperforming market. So yes, like acetone and phenol that I mentioned before, MMA also remains under pressure, and without any kind of protection, trade protections in place, and as it's also a net import market. And now, if demand does not recover or at least stabilize, there could be a risk of further rationalization. And to be honest, we already in the EPCA get some kind of news that could support that. Yeah.
I think really the conclusion is, you know, price developments have never been more important to the market, and what's happening in prices, whether it's in America, in Europe, or in Asia, are vital to the continuation and the development of this industry. So that's really where we should conclude today, I would say.
So on that note, we'll bring the panel session to a close. Thank you very much, Marilena, Luc, and Daniel, for your insights. I think on tariffs, this one is going to stick around. This one isn't going to go away anytime soon. There will be more announcements. There will be more uncertainty, and the industry is going to have to live with it. On competitiveness, this is such a fundamental issue for the European petrochemical industry right now, with so many issues and challenges to resolve, and you'll hear more about those later. So thank you once again. I'm now going to hand over to Andy and Katie and Nitu. But could we have a round of applause for our panelists? Thank you very much.
Thank you, Ian, and thank you to my pricing colleagues. I feel very fortunate in my role as Director for European Ethylene and having to forecast and predict the future, to have such a team of engaged price reporters around us to make that job a huge amount easier. And I think you've just seen a taste of how knowledgeable they are, so thank you. So I'm going to start off talking about some scenarios for base chemicals on ethylene before handing over to Katie to do the same on aromatics, and Nitu on the chlor-alkali PVC chain. I think I should probably just get straight to it and rip off the plaster and show this map, which is clearly the news of the last 12 to 18 months and a topic that we can't avoid talking about at EPCA. Since I spoke 12 months ago, this map has got a little bit busier, with the Salis 2 crackers in Italy's having closed already, Sabic's Wilton cracker being confirmed as not returning, and Dow and Total also making announcements about future closures, taking the total number in Europe now to 7. Meanwhile, LyondellBasell have announced their intention to divest 2 crackers as part of a 4-site deal to private equity firm Equita, and there's no shortage of potential future announcements with numerous other sites and portfolios very publicly under review or already up for sale. Too many to go through one by one on this chart. So what does this do to the ethylene balance in Europe? Well, I'm going to return to an updated version of a chart I shared last year, showing our production forecast for ethylene and a baseline operating rate based on the cracker landscape before all of this started. So taking 2023 capacities and extrapolating them forward. With the headwinds of low GDP growth, stubbornly high interest rates and inflation, trade disputes, global conflicts, all of the things that Adam talked about earlier, consumer confidence and buying sentiment remains low. Meanwhile, waste and circularity-related legislation threatens demand in areas such as packaging and automotive, and of course, imports weigh down on these blue bars, and I'll talk more about that shortly. All of this is contributing to a production growth that does not reach previous levels, and we would struggle to get above an 80% utilization by the middle of next decade based on this. But we don't have a 2023 landscape. We have new capacity in Antwerp that depresses this even further, and if I add Project 1 on, this would keep operating rates firmly in the 70 to 75% range right until the middle of the next decade. But with 5 confirmed closures and 2 more announced, about 4 million tonnes of ethylene is leaving the market, contributing some way towards recovery into the low to mid 80% range. But I think where we all like to be as an industry is the mid to high 80s, and this perhaps brings me to scenario number 1 that suggests the right-sizing journey isn't quite over, and potentially a further 1 to 2 million tonnes of rationalization is needed to reach those levels. But is there another way? How about bringing the blue bars up rather than bringing capacity down to meet them? And I earlier mentioned the weight of imports on that production forecast. And here we can see how that growth in imports has manifested itself over the last 10 to 15 years. This is ethylene or ethylene contained in derivatives, the ethylene equivalent. And we can see that that's nearly tripled since 2010 to about 6 to 7 million tonnes today. And our forecast suggests further growth of another 1 to 2 million tonnes over that 10-year time horizon. But 1 to 2 million tonnes, doesn't that range sound familiar? So let's go back to our first chart, which shows that 1 to 2 million tonne rationalization scenario at the top. And let's see what happens if we just held imports at current levels. Just import what we're importing today, but let's stop that growth of imports, nothing else. And because it's of a similar range, you can see it giving us a similar recovery up to those high 80%. But what if we actually trimmed back a little bit? Not a lot. We don't want to turn the clock back all the way 15 years. We know that's not possible. But what if we just contained ourselves a little bit and trimmed back 10%? Well, if we added that back into production, you might even see us hitting 80% next year and a much better recovery from that. But that's all good in theory. Let's see whether that's really realistic in practice. And if we look at these charts, you can see that it really isn't. This is the landed cost today of HDPE in Europe coming from the US and being produced domestically, both on integrated and a non-integrated basis. And you can see that the advantage on an integrated basis for the US is about $400 per tonne, and $700 on a non-integrated basis. In fact, such is the difference that HDPE from a non-integrated US producer is competitive with integrated economics in Europe. And this would suggest duties in excess of 30% needed to close this gap. And the reality is we have 6.5% today, and potentially, depending on how the details of a trade deal comes out, this may even see them going down to 0. But that's today. And earlier on, Adam talked about a higher gas and lower oil environment, which in the past has given us some very strong years in Europe. So let's recap and have a look at those again, this time on the left in dollars per million BTU equivalent. And we see this going down to about $10 for crude and peaking at about $6 for natural gas. A tightening of the naphtha market, though, is strengthening cracks. So when we convert this into a Northwest Europe naphtha price, this sees us getting down to around the $500 per tonne mark. Meanwhile, ethane in the US is about $300 per tonne. If you flip to the right, you can see this does translate into a reduction in the US ethylene cost of production advantage, down from about 300 to 400 metric tons today, and maybe going as low as 200 metric tons. Is this enough to close the gaps that we saw in HDPE? Well, unfortunately not. So whilst the purple and blue lines, again, this is the delivered cost into Europe. So this is US cost of production plus freight and duties versus a US production cost. You can see those lines getting closer, but there is still a gap that is about 20 to 25% of the sales price, the sort of level of duties or subsidy elsewhere in the value chain that might be needed to equalize that. But is there somewhere else in the value chain that could subsidize that? Well, let's not look to the steam crackers to do so, because despite these lower crude prices, European variable cracker margins remain low for the next 12 months, and on a cash basis, they're still negative, meaning that survival in the near term is the challenge, regardless of what those longer term prospects look like. So to summarize, rationalization is well underway, but Europe isn't yet right-sized. The change in trade balance required to help address that isn't as big as one might assume, but a lack of tariffs, coupled with a strategy from the global majors that are closing plants in Europe to maintain market share by importing, is not suggesting that those imports are going anywhere soon. And clearly changes in feedstock are not enough to address those structural issues and the structural disadvantage we have in Europe. So at the risk of finishing on a somber note, and despite my attempt to explore some alternative scenarios, unfortunately we may not have heard the end of this rationalization story, but I am all open to ideas as to what scenarios 4, 5 or 6 might be to offer a slight alternative. And with that, I'll hand over to Katie now that maybe has more positive news in aromatics or maybe not.
Thank you, Andy. And I'd like to really extend some of the themes that Andy picked up and explore into one of the other derivatives, again linked into the ethylene chain, looking at the styrenics industry, and again look at those themes of rationalization and restructuring, the impact of the lower oil price, and does that have a significant impact, and also overlaying the impacts of tariffs and trade that we see having quite significant changes on the benzene and styrenics markets, as my colleagues Daniel was earlier discussing. It's a slightly less remarkable picture when you look at the numbers for styrene, because it's a smaller industry, but we're still seeing about a good quarter or so of capacity has rationalized. This process started a little bit earlier than for ethylene, already since 2022. We've seen this new wave of closures taking place. And indeed, as in the ethylene picture, we see that further discussion from major players in the European chemicals industry, interest to divest their portfolio, could impact how the future of some of those styrene assets look. We also note that we have seen one of the styrene plants in Europe losing its upstream feedstocks, the ethylene and benzene provision into Italy. So there are quite some similarities as we look downstream across the derivatives. And indeed, again, Andy showed an import perspective for contained ethylene. I'm afraid I've turned my graph the other way up for you this time. So you're looking at imports at the bottom, but again, we've seen that this is not a completely new picture for Europe. As Daniel was saying, we've seen this emerging for some period, but we see increasing imports of not only styrene, but also as Europe moves up that cost curve, and as styrene has moved into oversupply, derivatives moving into the European market. The total is shown in the graph on the left. If you look to the right, you see where those imports have been coming from, primarily the US in blue, and the Middle East in orange, with a spattering of imports even from Northeast Asia and China in red. As regards the Middle East, this is a increasingly competitive, Europe is an increasingly attractive market for the Middle East. It's losing exports into China in particular. This makes India, Southeast Asia, a more competitive location for all exporters of styrene. And then add on the fact that as we look to 27, 28, India builds its own styrene, and therefore the styrene export market remains highly competitive. This makes Europe a really attractive location. As regards the US, again, if you look at that graph on the right, you can see a hint of the synergistic relationship between benzene and styrene that Daniel spoke of, with benzene exported from Europe being in excess and importing styrene from that market. The basic picture here for that trading relationship is quite clear, as Andy discussed, the advantages of the ethylene producer in the US, even when you look at a product such as styrene, where it's only 20% of ethylene going in, and the energy costs in making styrene are sufficient to mean that you can export benzene from Europe, pay the same freight to re-import that molecule of styrene back into Europe again, and it still doesn't outweigh the US producer's advantage. And that is true in that lower oil price scenario as well, where we spoke about Europe doing a little bit better, but if you look in that $58 barrel range, it still holds true. But here we do see one possible change. If you add on the full cost of a 15% tariff for benzene imports into the US, that does actually change slightly the nature of the relationship. It means that if that tariff is fully covered and those costs of freight, on paper, a European producer becomes as competitive or slightly more competitive than the US. So is that going to change things? Well, I think the concern here comes in terms of the demand that we spoke of earlier. And we mentioned that there are very significant other reasons for styrene exports to be competitive. So yes, it makes a difference, but only if you've got enough demand for that to help. Europe is going to look increasingly attractive to a Middle Eastern importer of styrene. And I think we can see that probably in the trends at the minute. We'll probably see more flows in that direction. This may also only be a temporary picture. If US producers of styrene derivatives are able to gain a manufacturing duty drawback, this will be removed. And this could take perhaps 6 to 9 months or so. So we do see a temporary potential for a different situation. But note, this only applies if you're not in a disposal mode for styrene, as it's at the minute as we come to the end of the year in Europe, and if you see the US needing to pull in benzene. We don't have enough time to explore the benzene trade tariffs fully in this situation. We'd be very happy to talk after drinks, but we do probably see that spread increasing early in the new year. And what about Asia? We saw those little red tabs on the chart that were bringing in some Asian volumes. Well, certainly, yes, there is a premium for both styrene or styrenic derivatives in Europe, and that looks pretty attractive, but there are some significant barriers to entry, whether it's the time this takes, the volatility that we see in that styrene spread, the nature of the material when you look at EPS and the degrading of that material over time as you import it, the barriers to entry. You can see why you would be looking at anti-dumping on ABS. So there are significant barriers to entry, but as we've discussed, it comes down to demand, and not just the demand for styrene and styrene derivatives, but for the end products that our consumers are manufacturing. And a manufacturer in Asia has a significant advantage over one in Europe when there's this difference in raw material prices. So we see a synergistic relationship between this European benzene and the US styrene market. That could temporarily see an equalization in competitivity for a brief period, but there are many exporters of styrene looking to take advantage of that situation. And if it returns and the US is able to claw back that duty, this will be an extremely attractive flow for somebody to go and buy the benzene in that market. In summary, Europe is a very attractive destination for styrenics materials, but the degree of reprieve for a European styrene producer is somewhat limited without sufficient demand and in an oversupplied market. And now at that moment, I'd like to hand over to Neetu Singh to explore the inorganics and vinyls markets. Neetu.
Thank you, Katie. Good afternoon, everyone. Thank you for being around here with us at EPCA 2025. My name is Neetu Singh, and I work with S&P Global, covering South Asia and EMEA regions for chlor-alkali and vinyls. As I begin with my presentation, here are the few points and highlights that I would like to take you through, and North America and EU statistics of supply-demand, the updates and records of global trade, some key and impressive China direction, and summarize for the key forces reshaping these markets. In spite of numerous challenges today and likely through 2026, there are items and certain geographies for chlor-alkali and vinyls that are performing poised for growth ahead. So this summarizes PVC for US and Canada. On the second line, you will see that it was an impressive 2024 and fairly unique as production, exports, domestic volume were up around 4 to 9%, not the normal growth that we see in commodities. 2025 is continuing that positive growth and global production participation. The blue line shade depicts production, which is up 4% in 2025, with new capacities, stronger domestic and export volumes. The purple line depicts domestic demand, and while housing was down, infrastructure and piping projects lifted domestic US PVC 9% last year, and slightly higher again year-to-date in 2025. Alternatively, the gold line depicts export sales, which are up by 10% in 2025, representing 35% of production for the year. We expect this momentum to continue and North American producers to run slightly higher through 2026 versus 2025. So now moving over to European chlor-alkali and PVC. Globally, we estimate that chlorine is up by 2%, around 78 million metric tons in 2025. On the left side of the chart, Europe's chlor-alkali declined in parallel with the Ukraine-Russia war back in 2022. 2024 was a lift of 10%, and we saw January off to a great start. But a dip occurred, and we are running 4% lower in 2025, and with which we are expecting a step up in 2026. On the right side, Europe is seeing a PVC market drift a bit lower in 2024 from 2025 from 2024. So not surprising, as over 40% of chlorine is being used just for production of vinyls. In 2024, chlorine global production fully recovered to match 2021. So caustic soda exports are shown to be setting a new record high in 2025. The chart on the left details the summary of each year in the past decade, with annual growth from 10 million metric tons in 2015 to now about 11.5 million metric tons expected to be in 2025. 2023 volume was a bit lower than what we had seen in the past decade. Lower production in Europe and US has led to some of this, and 2024 reversed this trend and volume with 10.8 million metric tons. The right side displays the regional trends. EU has been the largest, but also the most dynamic in the past few years. Western Europe has declined 33% in the last 3 years, from 3.9 million metric tons to 2.6 million metric tons. China has also dipped by 40% in 2023, before a lift in 2024, and a very large jump occurring now in 2025. Australia and Indonesia have been the key destinations for China for its exports. While China exports are around 30% for PVC, only 6% of liquid caustic soda is exported from China. And we don't see these global volumes declining, but we do not see China or US lowering their exports in 2026 either. So on the left side is the global PVC export totals, and you can see that the consistent increases year over year. 2025 will also be a new record high year for PVC. We expect a 15 million metric tons plus of total, up by 10% from 2024's record. Not what we would have been expected with all the global tariff discussions and existing anti-dumping duties taking place in PVC. So the largest two exporting regions have always been US and Europe historically. The US ships most of it to Canada, Mexico, Turkey, and India. On the right side are the details of change and growth of exported PVC. The green line has represented the most dynamic one, representing China. China has lifted from 500,000 metric tons in 2019 to what is expected to be around 4 million metric tons in 2025. China has jumped 8x in the last 6 years. And in 2025, India, Russia, Vietnam have been the key destinations for its PVC exports. So the prices and cost matrix for PVC in Western Europe remain down and challenging for the industry. 2025 will yield one of the lowest pricing years, only slightly lower than what we have seen in 2024. The good news for the producers is the reality of lower power costs than a few years back and lower ethylene, which is good for those that make PVC. But at these price levels, producers in EU are not making money, and they need to capture it from liquid caustic soda. So China is an incredible and dynamic story on PVC, more so in 2025 than the other year too. It is following what it had done over the past 30 years in terms of automobiles. China makes about 2 million metric tons per month of PVC, and they are exporting nearly 30% of their production for both PVC resins and various PVC products. 7.5 million metric tons out of 25 million metric tons is exported out of China. And in 2025, exports of PVC resin and PVC products are up significant double digits percentage from 2024. China's core for power is evolving and enhancing with enormous leaps into renewable energy as well. So also bullish are the new capacity projects. PVC capacity grew at 1.1 million metric tons over the last 5 years. And in the 5 years ahead, we are expecting projects 9+ million metric tons totaling through 2029, or rather I should say 1.8 million metric tons per year. These are the 20+ projects currently underway or planned to be there through 2029. China and India alone will represent 70% of these projects. And these are the projects which we have put on. There are other possibilities of announcements that we are still researching. There are also announcements of idling and closures in the next few years. We will continue our analysis and advise for future developments. There are also 25+ chlor-alkali capacity projects totaling 9 million metric tons through 2029, and announcements made and confirmed by S&P. 2/3 of this is coming over in China and India. 1/3 of it is coming over in US, Middle East, and Southeast Asia. In the last 5 years, in the last 10 years, the average has been around 1.5 million metric tons per year of capacity additions. However, in the next 5 years, the announcements total to 2 million metric tons per year of additions. So this is a step up today of capacity and capital investments, which is clearly indicative of more bullish expectations and requirements for chlor-alkali and vinyls demand. Now, to summarize my presentation, while we have challenges of GDP, geopolitics, and costs, the demand and investment plans will grow in key markets, will continue to drive chlor-alkali and vinyls. Having demand tied to growth and infrastructure, and 50% of the global demand tied to GDPs of India and China, puts chlor-alkali and vinyls in distinctive territory. North American costs will be slightly higher, putting pressure on prices and margins to the producers, but we expect North American production to be slightly higher for PVC and chlor-alkali, driven by eventually lower rates, more domestic demand, and their export territory, and their export positions for PVC, VCM, and LCS. EU's 2025 is off to slower start that we were hoping for in 2025. And because of this, capacity and demand growth over our forecast period for chlor-alkali and vinyls will exceed the averages that we have seen over the past 10 years. Thank you for your patience and for providing the opportunity to present our view on chlor-alkali and vinyls. I would like to hand over the stage to my colleagues Olivier and Devi.
All right. Good afternoon. Thank you very much, Nitu, for the presentation on PVC. We're just about to start the last session of today, and really we couldn't talk about kind of the chemical industry without talking about sustainability, and that's really the topic of today. The last session, and trying to understand whether Europe could really play kind of a front-runner role in sustainability across the chemical industry. And we're going to touch on two different value chains. On the one hand, the methanol value chain, and on the other hand, the polymer market as well, to see what is Europeans' position on this. My name is Olivier Maronneau. I lead our global research around methanol and plastic circularity. And I was mentioned by Nitu, I'm going to be joined for the next part of the session on the polymer market by my colleague Davy from our editorial team. So with that, let's jump about this low-carbon methanol story and really kind of trying to understand what's happening in Europe. But before really we talk about low-carbon methanol, I wanted to give a bit of a recap of the current methanol industry in Europe. And really, when you look at this industry, not really a big industry. I mean, if you're not a player into that segment, you probably haven't been deeply involved into methanol. But really, it's a story where you have a kind of a shortage of capacities, and global production capacity is probably equivalent to half of the overall demand for European market. The European market is not a small market, right? It's about 10%, slightly less than 10% of global demand, and we talk about 8 million tons of overall methanol consumption in the region, West and Central Europe. So it's not small, but as I said, very limited capacities. Some of that capacities went down when we had the gas crisis. So back in 2022, 2023, on the back of the Russian and Ukraine start of the war, we had already some capacity closures coming up at that time. And so as a consequence, the overall methanol market in Europe is very much a net import story. You have imports accounting for about 75% of the overall consumption. So that's about 6 million tons of methanol that is imported. Trade flows has shifted quite significantly, and obviously because of the size of the import market, that's quite important. Used to be heavily driven by Russia, and then that has moved towards the west, towards what's happening in the Atlantic Basin, and to some extent what's going on in the Middle East. And so really a bit of a two-tier market when you look at the global market. On the one hand, Asia, and the other hand, the Atlantic Basin. If we dive a little bit closer into what's going on into the actual methanol market in Europe, again, fairly straightforward story, right? You have three derivatives, formaldehyde and some of the fuel, biodiesel and MTBE, that account for about 75% of the demand in Europe. And then the rest is all of the chemical application that uses methanol, but not in a significant kind of way for each of the derivatives. And here the story is same as well. On the chemical side, there has been kind of soft demand. I'm not going to go through that. It's been mentioned across kind of what we see in other value chains, but obviously what's going on in terms of construction industry, automotive industry, the overall consumption in Europe has not been really pulling methanol consumption. But it's also a question of economics, and especially not so much on the methanol side, but you do see other capacities being built in China, in the rest of the world, in the US as well, on some of the downstream, and that is putting exacerbating pressure on European producers downstream. In the coming years, we see two different trends. I think eventually The chemical market is quite cyclical. So at some point, you will see a pickup in consumption, you would see a pickup in the construction industry, and that's going to drive some of the demand into the chemical applications for methanol. That's great, and that's probably account for slightly more than 50% of the overall demand. But the fuel segment, and particularly the MTBE segment, that's exposed to the decline of gasoline consumption that we see in the region. And so on the one hand, you would see some derivative growing, but some derivative will structurally decline in Europe over the coming 5 to 10 years. So that's the story on the conventional methanol. But it's not, as I said, it's not just all about conventional methanol, it's what's going on and what is the potential for low carbon methanol as well. One side of the coin when we talk about low carbon is obviously what's going on in the chemical industry, how do we decarbonize our industry. And when we look at the carbon emission, the GHG emission of chemicals in Europe, you talk about 5% of the overall emissions of the European market. And more specifically, when you look at which segment within that chemical sector kind of emit the most, and obviously anything that is heavily energy intensive, crackers, ammonia, to some extent the chlor-alkali sector, those are significant part of the industry that emits and produce most of the GHG emission in the industry. As we look into a net zero world, whether it's 2040, 2050, whether we even try and meet the 2050 target, that's going to be the aim is going to be to try and reduce emission from those heavy GHG emitter sectors. But it's not, again, not just all about decarbonizing the chemical industry. The other key driver is trying to decarbonize the transportation sector. And when we talk about transportation sector, obviously we talk about what's going on the road, but it's also more and more the focus on shipping and aviation. And across all those kind of three different segments, we see again regulation that is pushing to decarbonize those sectors. Whether we aim to reduce GHG emission, that's what we see as part of the FuelEU Maritime in Europe. Whether you try and push for mandates for renewable fuels, whether it's in the Renewable Energy Directive or into the ReFuelEU on the aviation side. So really you have a wide range of different regulation that is trying to push to decarbonize those different sectors, and in fact regulation is more advanced on the fuel side than it is on the chemical side. And that's probably one key driver that could potentially support the low carbon methanol story, especially because in some cases you do have sub-target as well for what we call RFNBO, renewable fuel for non-biological origin. And as I said, that's eventually where the methanol story comes in. From the supply side, methanol currently primarily produced from natural gas on a global scale, from coal, if you look specifically at China, but methanol can be produced from green hydrogen and renewable power. It could also be produced from fermentation and biomass. Most of those technologies, they do exist at scale. They're obviously quite expensive. They've got a lot of different issues, whether it's feedstock related, capital cost, but those technologies do exist. And on the demand side, methanol opened up the door to different end uses. Obviously, the chemical application, I've just mentioned the largest kind of end use for methanol and one where decarbonization is key. But methanol, as I said, is also used as a fuel, whether in Europe we talk primarily MTBE and biodiesel. In some cases, we look at direct blending of methanol into the gasoline pool. In some cases, we even talk about methanol to gasoline technologies as well. And then more and more, the drive towards methanol into shipping and methanol into jet fuel through the methanol to jet pathways. So really, and that's when we talk to a lot of non-industry players, non-methanol producers, when we talk to investors, this opportunity to see methanol being extremely diversified in terms of its potential market, that's a key support for our industry. And in fact, we do see already quite a lot of projects happening in Europe. On the chemical side, the key focus seems to be methanol to olefin. At the moment, this is very much a China story, but there are 2 companies in Europe that have been kind of looking at developing projects in order to produce so-called low-carbon olefin that would eventually translate into low-carbon polyolefins. It's not just the chemical side, as I said, on the bunkering side that has been, or that has made the headline quite significantly over the last few years. We see shipping companies investing into what we call dual fuel methanol-ready vessels, so vessels that run on conventional bunker fuel and have the ability to shift to methanol. But we see a lot of initiative from the rest of the industry, ports and port authorities, from storage companies, from bunkering companies, to try and bring kind of players together and start developing an offering to those vessels and those shipping lines that run those dual fuel vessels. That's the case in Rotterdam, it's the case in Antwerp, and we see different ports in the region, not just in Europe, but we see among the European kind of market, those are the few key players that are really pushing towards developing that offering. And then finally, the methanol to jet. Not as advanced as the other applications, not that advanced primarily because the regulation and the certification of that pathways is still waiting. But we see already a number of companies that have been, again, making the headlines, making news, and trying to look at project development in the ARA region, in the Iberic region as well, to try and develop the methanol to jet pathways. When we combine all of those projects, we track kind of their progress. We assume that's over 3 million tons of methanol that could come up into the European market. So we look at a market of 3 million tons. You can see that market's almost doubling should those kind of initiatives on the low-carbon methanol side materialize. Not all of them will materialize. They're not going to materialize in the next 5 years, but should they materialize at some point, that's really going to increase methanol consumption. And so the question is, if you have that potential pickup in demand, what's going to happen to the supply side? Are we still going to increase our kind of imports of methanol and low-carbon methanol? Are we relying on other producers elsewhere? Are we going to try and develop the low-carbon methanol story from a supply to demand side in the region? And I would say on the supply side, the space has been probably as active as what we've seen on the demand side. There's been over 100 projects that have been announced into the wider European region. A lot of those projects have been announced in recent years, but some projects are dated back almost 10 years ago. They're not really making any progress. Some of them have most probably been scrapped by then. But really, that has been a story that companies have been investigating for quite some time. One of the key progress that we've seen is actually the first so-called large-scale e-methanol plant in Denmark, just commissioned earlier this year. I say large-scale because it's a 35 KT plant, so out of a market of 8 million tons is relatively small, obviously, but it's the largest e-methanol plant that is currently operating. And we see, as I said, a number of projects that are making some sort of progress. We see grants and we see some financial supports at the EU level that is really supporting some of those. But ultimately, and as I said, with some projects being as old as 10 years, overall, it's a long-term game. So when we look at Europe and what's going on in the rest of the world from a methanol supply side or low-carbon methanol supply side, actually methanol is probably losing a bit of steam. We've got over 100 projects or close to 100 projects that have been announced in the region, but globally we track over 300 projects. Most of those projects have been kind of announced and have been developed in China, and in fact China is probably leading the way in terms of putting that supply chain in place, whether you look at e-methanol with renewable power, green hydrogen, and the CO2 sources to produce methanol, or whether you look even at the gasification side with bio feedstock or with municipal solid waste. Outside of China, probably the US is the other places where we've seen some progress. Also, as you could imagine, there's a lot of unknown and a lot of kind of moving pieces in that part of the world that tend to derail a little bit some of those progress. But as we look at what makes those projects progressing, what's really the key kind of enablers for those projects? I mean, not a surprise, but obviously competitiveness, whether we look at competitiveness of accessing feedstock, or in some cases, and especially on the e-methanol side, the green hydrogen side, where capital cost is so high, then trying to reduce your construction cost kind of is a very important lever for improving your competitiveness. And that has been probably one of the most important driver behind some of the Chinese projects. They're able to reduce significantly the cost of the green hydrogen, and as a consequence, feeding that directly through the methanol side. In some cases, having a very clear regulatory environment and support scheme. That has been the case, obviously, in the US up until recently. But that extension of the 45V that we anticipate until the end of 2027 could be enough for some of those US projects to actually start construction by then and be able to claim that part of the grants. And so again, having that clarification on the regulatory front and how to reduce production costs through support scheme is really important. And then finally, partnerships. This is a new part of the industry, brings up new players, and therefore you need to have that incentivize that collaboration and that kind of working together environment that, again, we see very much happening in China, either because companies tend to integrate their value chain or whether because they kind of work very closely together and go ahead and build projects, and sometimes what we're missing in Europe. But at the end of the day, and that's what is very interesting, is whether you go to China, whether you go to the US, everybody looks at Europe for the target market. Because everybody looks at trying to understand the regulation in Europe, everybody tries to understand where they could place their product, and so ultimately we're all chasing for the same end demand to some extent. Obviously, companies are looking at what's going to happen on the global scale. In 2 weeks' time, there is the IMO meeting to try and approve the framework around net zero for the shipping industry on the global scale. But ultimately, as I said, on the short to medium term, everybody looks at Europe. And so really to wrap up, and then leaving the way to my colleague on the polymer side, but the methanol industry, as I said, ultimately, we're not competitive for conventional methanol. We've got very high natural gas prices, and so the industry is structurally short, relying on import, and that's not expected to change anytime soon. On the demand side, there is some growth opportunities, and eventually even on the conventional methanol, as we see, as I said, pent-up demand and recovery into the chemical business. But if you look at the conventional fuel, again, probably on the gasoline side, the story is for decline. But really the growth story on the methanol side, besides all of that kind of negative outlook, is around decarbonization, around what could happen on the low-carbon methanol side, and how can we crack that story between production, cost, competitiveness, and decarbonization across different end uses, not just the chemical, not just the road transportation, but eventually shipping and aviation as well. And so with that, thank you very much, and I hand over to my colleague.
Thank you. So we will now be moving over and looking at the recycled markets here in Europe and assessing whether the legislations that we have are enough to push forward for a sustainable sector. So to begin with, Platts is historically known for its coverage of the oil markets, but we have a strong passion for sustainability and energy transition, and it's evidenced through our expansive coverage of the recycled polymers market. And during our coverage of the various polymers markets in different regions, we do see how different regions take very different approaches to promoting sustainability. We see in China, where there is a government incentive, so a lot of state-owned investments and a lot of state-owned control in pushing for sustainability. While looking in the US, it's a lot more incentive-driven, so tax subsidies or tax rebates for the usage of sustainability. While here in Europe, we focus a lot more on regulation and setting targets for the inclusion of recycled material in packaging. So looking at the current legislation that we have here in Europe, we have the Single-Use Plastics Directive, SUPD, and the Packaging and Packaging Waste Regulation, PPWR. The SUPD is split into two parts. The first part covering requiring a minimum recycled content in beverage bottles, so for example 25% from 2025, and increasing to 30% in 2030. On the flip side to this is looking at the collection of these materials that are placed in the market. So by 2025, EU member states should have a minimum of 77% collection rate, increasing to 90% in 2029. While the SUPD primarily focuses on the PET and rPET, the PPWR looks to expand the usage of sustainability into other packaging forms, so including PE, PP, ABS, and various different forms. So really building on the targets set for rPET and the beverage bottles and encompassing various different applications. And in addition to these targets that you can see behind me, there are also bringing into focus how the packaging design is designed and looking at empty space and really questioning how much packaging we use and the recyclability. Now, this came into force in 2025 in the application, and the targets aren't set to be met until 2030. But of course, with an increase in demand for recycled material, the question then lies, where are we going to be getting the material to recycle? And this is where we see Europe really turning into the deposit return scheme. Deposit return scheme essentially means when, as a consumer, when we purchase, for example, a bottle, we'll pay a small fee. And if we return this bottle to a designated place, typically in a supermarket, we'll receive that deposit back. And it's definitely a popular scheme that we're seeing across Europe. You can see the countries in dark blue are countries that have already implemented the scheme, and it's proven to be quite successful. On average, it's around 87% collection rates in these countries, so far exceeding the target for 2025 in Europe. Now, we also have countries in light blue. They're the ones that are currently considering adopting this DRS scheme. So we have the UK, which is set to introduce this scheme in October 2027. And we also have Spain, who's also looking to implement the scheme in 2026 of November, after the latest data revealed by the Spanish ministry saying that they've failed to meet their interim target for collection rate for 2023. So opting for this new scheme to increase the collection rates to meet the EU targets. Now, though we've focused a lot on the EU, it's quite interesting to note that how the legislations and the targets that we are setting here is influencing other markets. So although I previously mentioned that in the US they primarily take an incentive approach to incorporate sustainability, we are seeing a growing number of US states looking to implement minimum targets for recycled packaging. So we have, for example, California, which has quite a similar target to us here in Europe of 25% by 2025. Now, we also have other states in the blue, the navy, and light blue. They're currently they have extended producer responsibility bills in place, but are currently working out the targets for recycled content. So definitely the work that we're doing here in Europe is definitely influencing other regions as well. So we've spoken about the current legislations in place, but it's also important to see whether this is whether this is actually impacting the demand in the markets. So we look at rPET first. So we have the 25% from 2025. But when we look at the pricing mechanisms and the pricing of rPET compared to the virgin, we definitely do see that the virgin prices maintain its competitiveness against the recycled polymers. And as a result, we've definitely seen this translate into consumer preference and choosing between that recycled or virgin material. We have this target, but there isn't any penalties announced for non-compliance. And with smaller converters here in Europe, we are seeing that they are preferring to incorporate more virgin material as opposed to recycled materials, because they're working on smaller margins and taking advantage of the virgin prices, which maintains its competitiveness of roughly around a €700 discount to recycled material. They're taking advantage of this. Now, that said, we do see big consumer brands maintaining their usage of recycled material, but certainly not to the extent that they used to in the past. We've heard from several converters here in Europe where their clients used to request 100% recycled material. They're now decreasing this to 30 to 50%. So still above the requirements from EU, but given this pricing mechanism and the spreads between recycled and virgin, we're definitely seeing a greater preference for virgin material over recycled. So definitely we do have this incentive, this legislative incentive to use more recycled material. but at the forefront of discussions is definitely the sustainability versus cost-effectiveness. And taking a deeper look at what's happening in the virgin markets, we definitely do see it's a lot more influenced by upstream feedstock markets. Virgin PET and recycled PET, they have different feedstocks, and that means that they will follow different pricing trends. So though we see decreases on the virgin price, we don't necessarily see this translated into the recycled. And looking at the feedstocks for PET during this year, with the volatility we've seen in crude and geopolitical tensions, it's definitely come down since the beginning of the year. And as a result, this has increased the competitiveness of virgin material over recycled. We do, however, see that on PX and PTA, a key component in the production of PET, because it has that, because of the stronger euro we've been seeing against the dollar, the decreases haven't been as pronounced as MEG, for example, but nonetheless, the decreases have been seen here in Europe. But that said, we are seeing that on the PTA side, at least, that Europe is definitely being impacted by the rationalizations that have been happening quite frequently here in Europe. We've lost 2 PTA plants over the past 2 years, and at the moment we have 3 main PTA producers, which with a reduction in the PTA production in Europe, we definitely do open up ourselves a lot more to exposure to the international markets. So when prices changes globally, we have less to fall back on in domestic terms. But looking at the wider recycled polyolefin side, we do see it's following a very similar trend to recycled PET. So as I've mentioned previously, in 2030, the target set by the EU is going to expand to the other recycled plastics. And as we can see, the pricing spreads between virgin and recycled. Virgin does maintain its competitiveness against the recycled counterpart. And this year, we've definitely seen a widening spread. And quite importantly to note, in the pink line, we've seen recycled LDPE. We started the year with recycled material being at a discount to its virgin counterpart, but with the decreases seen in the virgin markets, that spread has flipped, where now we are seeing recycled LDPE at a premium to its virgin counterpart. So it definitely puts at the forefront the sustainability versus cost pressures for consumers. As we've mentioned previously, there's higher costs, higher energy costs, higher labor costs here in Europe, and with imports not necessarily following the same cost structures here in Europe, we're definitely seeing the pressure on consumers to look for more cost-effective material. So similar to recycled PET, the recycled polyolefins are also seeing this switching of consumers preferring virgin material over recycled. There has been a push for I guess, a penalty from these legislation for the consumer to narrow that spread and make the recycled material more competitive, or at least be able to compete more against the virgin. But unfortunately, we haven't received any penalties announced as yet. Another piece of legislation that we didn't mention previously is the end-of-life vehicle directive. This is similar to the packaging ones that we mentioned previously, but this is more applicable to the automotive industry. This looks at incorporating more recycled material in the production of cars, for example. And even here we are seeing that this is impacting more polymers in regards to others. For example, recycled PP is seen to be the one that's going to be impacted the most, whereas others that use less or have a higher cost, their recycled material, for example, recycled ABS, we're seeing that this legislation is going to impact that material far less. So definitely seeing that depending on the cost and the material used, it's going to impact different material more than others. But although we're seeing, and as I have mentioned, that there is that pressure from virgin materials, we're also seeing the pressure between interpolymers. So we hear from players that are comparing the prices of different polymers, and where possible are interpolymer switching. So we're seeing this quite regularly on recycled ABS, where players are able to switch to recycled PP. They're opting for it due to that cost competitiveness. So to summarize our main points that we've mentioned in this presentation, sustainability and cost pressures maintains the key target. Consumers are forced to choose between whether incorporating these targets, which comes at a higher cost than its virgin material, or in the face of the current economic situation here in Europe, preferring to choose for the most cost-effective material, which is its virgin counterpart. Another one is this import dependency amid the production decline. We've, as previously mentioned today, we've seen quite a few closures in the recycling industry, but also on the virgin material, on the virgin production as well. So PTA has been quite one that we've been seeing quite a few rationalizations. So with these closures here in Europe, it definitely does open up Europe to more exposure for international markets and opens a lot more risk for imports. And finally, the final point is about timeliness and effectiveness of regulation. When speaking with market players in the recycled polymers market, 2022 and 2023 is definitely quoted quite regularly as quite a tough year. And one of the main reasons why we are seeing players really struggle at the moment and closing down. So although we have this legislation set for 2025, 2030, and further for 2040, some players are indicating that these targets are a little too late. I will now hand over to my colleagues to close the presentation. Thank you.
Well, that was fantastic. That was a fantastic session. I just want to thank you all, particularly for attending this afternoon. Really appreciate it, and I want to give my special thanks to all the speakers and the panelists. I'd like to give my thanks as well to EPCA for the hospitality, and certainly many thanks to the audio-visual team as well for helping us today. It's much appreciated. I could wax lyrical for the next hour because people know I can talk and I can go a little bit off script, so I won't necessarily bore you because I know we've got some drinks waiting outside in the Potsdam too. So I would love to join us, and please reach out to our colleagues this evening to find out any more questions. We'll have time this evening, and find them again tomorrow outside in our booth as well if you'd like more information. Just to say, I mean, the message I've got this afternoon, and actually for the 2 days I've been here already, and in recurring meetings here at EPCA, this is what gets me up in the morning. This is what's really exciting. I mean, I've been in the chemical industry now for over 30 years, and why did I leave? I couldn't leave because if I cut me in half, it says chemicals. And even though there's issues and there's problems, Andy mentioned about ripping off the Band-Aid, it's going to hurt. Sometimes you have to take the medicine. But there's so many opportunities that go with that as well. So that's what gets me up in the morning. I'm a big believer. As I say, I head up specialty chemicals, and innovation really is the key to unlock the growth that we're looking for. So I think we need to look at getting fit for growth in Europe. The growth will come, whether it's for Europe or for the export markets. And everything that you've mentioned there as well, I've listened to the presentations about plastics recycling and methanol. These have to come. It's a bit like, what's the phrase? A stitch in time saves 9. The longer you leave it, the more expensive it gets. So if we can get the jump on that in Europe, I mean, Europe's always been the cradle of innovation. So I think the people in the audience here, these are the leaders who can get us out of this. We can't do it on our own. You mentioned again about collaboration and partnership. Sometimes this is too big to tackle. And if we can reach out and get collaboration and get all the, get the ducks in a row, connect the dots, not just from legislation and from governments and support and social acceptance. Sometimes, if it was just left to us, we wouldn't necessarily do it. You might be lazy if you don't do the recycling. I live in Switzerland. If my boiler breaks, I have to replace it with a thermo pump. It's going to cost me money. There might be a little bit of government support, but I'd have to finance that. And in the greater picture, I think if we all did that, that's basically puts us in a great place for Europe. So I'd like to thank you all again for all your leadership and attendance. Just to mark your calendars as well, we'll have our World Petrochemical Conference in 2026. So that's going to be in Houston, March 23rd to the 27th. So registration is now open, and I would love to see you all there as well. My team's going to be there. The rest of S&P Global's chemical team is going to be there. It's going to be a great event, so please put that in your calendar. And I wish you all the success for the rest of this year. And I say, please reach out to our team later. We're very, very happy to help you. So thank you again.